Hey folks, Dan Frio here with your rate update for February 1st, 2024. So yesterday the Federal Reserve came out and a lot of news channels are saying, well, they basically took the March rate cuts off the table. Well, we're going to dissect that. And then we're also going to dissect what happened in past recessions, because a lot of people are saying, well, a recession's on the horizon and people are going to lose their jobs. They're going to lose all their money. If they own a house, they're going to get foreclosed on. And if not, house prices are going to plummet. So we're going to go over these two topics in today's video. So without further ado, let's get to it. Right here is what you're seeing. These are the top 6 programs people use when they're buying their first house. The gist behind this is these are not my rates. These aren't Bank of America rates. They're not even Chase's rates. What they are is Mortgage News Daily. Right up through there, they survey lenders all over the country and ask them these 5 questions. 5 questions are, if you had somebody buying their first house, it was a single family home and they were going to live there, meaning it's their primary home. And then they have a 780 credit score and they're putting down 25%. That's where the rates would be. So if that's you, that's probably most likely where your rates are. If it's not you, I'm going to give you all my information at the end of this video so we can figure out what kind of rate you can get. So without further ado, let's get over to it. So you see rates, it dropped a little bit. What happened yesterday? Well, the Federal Reserve came out and they said they're not going to do anything at this meeting. And they might not do anything at the next meeting. That's what we're going to talk about. So let's dive into the information that we have for today. The first thing we go over on my channel on a daily basis, if you're new, is we go over the economic calendar, because this data right here is what's going to affect mortgage rates, because it's affecting what the Federal Reserve is going to do. Okay, so that's kind of what we're talking about. So right now, what we're focusing in on is what the Federal Reserve focuses in on is employment, wage growth, and then what else do they look at? Inflation. That's what it is. So they just look at those things because their mandate, the mandates for the Federal Reserve, or basically why they were created, is for price stability, aka inflation, and to keep the jobs numbers at full employment. So let's get over to see how things are going. So the first thing we want to see today is continued jobless claims. How many people are out of work and continue to stay out of work? Last number was 1.828 million. It was expected to uptick just a little bit. It upticked a little bit more than just a little bit. It went from 1.82 to 1.89, a pretty significant number right there. So you have continued people on staying on unemployment. Well, initial jobless claims is one of the areas that the Federal Reserve is watching as well, and they want this number to get to about 300,000. Then they'll be comfortable saying, okay, not a lot of people are getting back in the job force, thus, you guys aren't going to have all this money to spend that's keeping prices up. So hopefully with this happening, prices are going to start to come back down. So right through here, we see initial jobless claims going from a 215,000 reading last report, supposed to uptick a little bit to 213. It upticked quite a bit to 224. So this is telling us the jobs market isn't as strong. It's actually coming down into the wheelhouse what the Federal Reserve wants. And then we have a couple other things. Non-farm payroll productivity, it's starting to drop as well. People used to produce 4.9% of their productivity. It's dropped to 3.2. So that's kind of not good news as well. But then here's some, I guess it's good news, but it's an uptick from the last reading. The last reading on labor costs, how much you have to pay your employees, it was starting to drop. It was down 1.1%. They expected that to completely reverse to up 1.3%. What did it do? It only went up a fraction of that. 0.5. So what this is in a ballpark, this is telling us is people are losing their jobs. They're having a tough time getting new jobs. And right here, wage growth is starting to slow. So this is right in the wheelhouse of the Federal Reserve. So the next thing we want to talk about is, what did the Federal Chairman Powell say? They're saying Federal Chairman Powell says March rate cuts is unlikely. Well, some people are saying they're not going to do it for sure. They're kicking the can till May. What exactly did he say? Because I want you guys to get the facts. If you go over here, here's what exactly he said. He added that a March cut is not the most likely or basis case scenario. He didn't take it off the table. Why do they do this? And I've been trying to preach this to everybody over the past couple of years. They're not going to release their cards. And here's what I mean. They're not going to come back and say, okay, yeah, in March, we're probably going to cut rates. What would happen if they came out definitively and said that? You'd see the stock market doing what it did the last 3 times the Federal Reserve met, and they were each up 1% in the day that the Federal Reserve announced what they're doing. The Dow Jones and the NASDAQ just jumped sky high. That creates wealth for people. People feel wealthy, they're going out and spending stuff. So what the Federal Reserve is saying is they're trying to kind of play their cards like a professional poker player, not revealing everything that they have. So kind of what my thought is behind there. They did not take it off the table. I don't think they're going to do anything in March. I really think they're going to start pivoting in May, but they did not come out and say specifically that they're not going to cut rates. They're kind of keeping that to their chest. Okay, so the next piece of the puzzle is I want you guys to understand what happens during a recession, because most people are saying right now, if we're going to go into a recession, and here's what's going to happen to you guys. You're going to lose your job. You have no money in the bank. That means if you own a house, you're going to get foreclosed on and lose everything. Well, that's one pivot point. And then the next thing is, why would you buy a house when you know a recession's on the horizon and home prices are going to plummet? So that's number two. Actually see what happened during the last few recessions. Now, I'm taking one or two of these off the table because we really don't need to know what happened in like the 1900s, 1920 during the Great Depression. It's not even relative right at these times. Home prices were so much lower and it was a completely different dynamic. But let's really dissect what happens to home prices during a recession. So when we break this down, you find this a little bit interesting and contrarian to what a lot of people were saying. Let's go through the Great Depression, because that was an anomaly at that time. Basically, I still feel, if you read a lot of documentaries about what happened, this might have been pre-set up, but I'm not going to go there. I'm not that kind of doomsday sayer. But let's go back through here. In the 1970s, what happened? So we're going to go 70s, 80s, 90s, 2000. We're also going to take out the 2007 and 8 crash, and you guys are going to say, oh, there you go. You took out the biggest crash in history. What caused it? What actually caused that crash? It wasn't monetary policy. It wasn't anything like that. It was basically way overinflated home prices because of subprime mortgages. That was the catalyst that took that. But let's go back to the 1970s. What happened? Well, if you go down through here, we're just going to focus in on the home numbers. You're seeing right here, 1970 recession. What happened to home prices? Well, given inflation was out of control, home prices actually shot up in the U.S. during the recession. New home sales prices, for instance, increased 7.5% at the beginning of the downturn, and the prices were up, let's see, what is this, 11.7%. So home prices during the 70s recession saw an uptick of 11%. Crash. So let's keep going. What are we going to see next? Let's see the next situation that happened in the 1980s. 1980s recession, what did we see? Home prices increased by 4.5% during the downturn as inflation stayed high. Studies show rising unemployment generally correlates with falling house prices. That isn't always the case. Okay, so let's continue on. That was 1980. Then we go into 1981 and 82, where we saw another recession. This recession was basically caused by the energy or oil. Unemployment hit 10.8% with interest rates punishingly high. They surpassed 20% in the fourth quarter of 1981. The house market was feeling the burn. Nevertheless, home prices still managed a 1.9% uptick. Not a crash. You continue to go over, and then you see the next thing is 1990s. What happened in the 90s? Well, a housing bubble that was developing in the mid-80s burst in this recession, with the normal price slipping 0.9%. Okay, so is that a crash, 0.9%? No. Okay, so that's basically, I want you guys to understand what's going on here. And then we have the dot-com bubble in 2000. House prices, what they do at that point? Rose 4.8%. So these are the last, 3 or 4 recessions we went over. Again, I'm not going to go over 2006, 2008. It was an anomaly. It was basically the government and banks created these mortgage products that were just crap. People got into them and they suffered, and it was the biggest catastrophic event that the housing market has seen basically in my lifetime and probably your lifetime as well. So hopefully now you understand where you really have to, question media. Federal Reserve really didn't say that they're specifically not going to do anything with the rates in March. They actually just kind of pocketed that and put it aside. Then people were also saying, well, unemployment's going to skyrocket, a recession's going to hit. I just showed you the last 4 or 5 recessions, housing prices really didn't do anything. In fact, most of the cases, they went up. Hopefully you get a little bit more understanding of the housing market and the economy. So without further ado, based on the data that we have today, what's going on with mortgage rates? So to watch that, what we do is we watch this. This is one of my screens that I have on a daily basis. What I watch is right here. This is the mortgage-backed security bond. This bond trades on Wall Street. Why do we focus in on this bond? Well, because the rate on this thing, or the yield on this thing, gets pushed over, and it's the biggest piece of your mortgage rate. So why would we follow a 10-year Treasury? We're not going to really follow what the Fed does because they don't control mortgage rates. This is the instrument that controls mortgage rate. So what we're seeing right now is right here. Here's the price of the bond. And right here, this says it is up 2 ticks. What I want you guys to understand is this. When a bond price goes up, which you're seeing from here up through here, what that does is it takes rates down. So price of a bond going up makes the yield or the interest rate come down. And that's what we've seen from here. Rates were about 8% right here. They went up. Well, the bond price went up to here. And this right through here, mortgage rates were 6.3%. So we had 8%, 6.3%, and we've been teetering in that range since that. So right now you're seeing an uptick of 2.2. That's not going to do anything. So here's where rates are today. Again, if you want to validate this information, in October, you can see right there, if you look at the little numbers, it's a 52-week high and low. You can see the 52-week high on mortgage rates was 8, and that correlates with this chart right through here. In October, right down in here, that is when the bond yields hit that rate, and we've had an uptick in prices, meaning downtick rates. So that is my report for today, but I did tell you I'd give you my information at the end of this video. So my name is Dan Frio. I'm a mortgage advisor licensed in all 50 states as well as Puerto Rico. I've been doing this for 34 years now. I'd love to help you. Okay, we can do multiple things for you. I work at a bank. It's a federal bank. Okay, what that means is I'm licensed in all 50 states as well as Puerto Rico, but we're also one of the country's largest mortgage brokerages. We're set up with right now about 73 different companies. What that means to you is I have the ability to use my bank's products plus 73 other companies' products and rates to help you guys out. So what do you do if you're locked in right now and you're seeing rates coming down? Well, please upload your loan estimate right there, okay? What your loan estimate is once you get pre-qualified, the lender's going to send you actually a package out, and it's going to have your loan estimate in. It's going to give you the price of the house, how much you're financing, what the rates are, and also what the fees are. I'm going to stress fees because I don't just look at your interest rate. I want to see how much you're paying for that interest rate. So if you're locked in and you have over 30 days left before you close, please upload your loan estimate right in there. We can take an analysis of it for you and see out of the 73 companies as well as my bank, can we get you a lower rate, maybe lower fees, maybe the above, lower rate and lower fees. But if you're trying to kick the can right now to see, okay, do I qualify? Do I make enough money? Is my credit score in line? Do I have enough of a down payment? All I ask you to do is don't disqualify yourself. Please reach out to us. Here's how you do that. You're going to hit the apply now button. That's probably one of the easiest ways to get started. What we do there is we don't just launch you off to an application system. We're going to have you answer a few questions. Based on the answers to those questions, I'm going to assign you to a specialist on my team who specializes in exactly what you're looking for. Okay, that's how we're going to help you. We're going to manage you from day one of the application all the way to the day you get the keys to that new house. But if you'd rather just call in or email me directly, you can scroll all the way down to the bottom of our website and you're going to find just that. You're going to find right here our 800 number. It's 844-775-LOAN, or you can email me right through there at dan@therateupdate.com. Love to answer any questions that you have. And yes, it is me who does the answering. So thanks so much for watching, guys. God bless. Have a fantastic day.